You're listening to Withum's Taxing Topics. When it rains, it pours. Tax regulations and guidance are dynamic, continually changing domestic and international financial waters. Step under Withum's umbrella to better weather the storms of tending taxing topics. We'll share the essential news and information you need to prepare for what's ahead.
Hello, everyone. My name is Lynn Musenski-Keck, and I am in the National Tax Service Group of Withum, and I'm excited to be with you today. Part of my responsibilities here at Withum is to monitor federal tax policy, and so we're excited to inform you that we're launching 5 podcast series, this being our first over the next few months. We'll be moderating and following that federal tax law reform. We're excited today because oftentimes when we go in to look at federal tax law reform, we forget to take a 10,000-foot view and get right into the nitty-gritty, as all true accountants do. But today we have a special guest with Philip Swagel, the director of the Congressional Budget Office, who's going to help explain to us not only the reasoning that we always go into of trying to get down to the nitty-gritty of the tax law, but bring us out of that detailed analysis and why tax revenue is so important for him and the Congressional Budget Office, obviously. So we're thankful to have Philip with us today, and I'm going to let him introduce himself.
No, great. Thanks, Lynn. Thanks so much. It's really a pleasure to be here and a pleasure to talk with you and reach your audience. Hello from the Ford House Office Building, where the CBO is located, and we're right at the foot of Capitol Hill. And I guess that works symbolically, that we are part of the Hill. We're part of Congress. We work for Congress. We support the Congress. But we're a little bit apart from it. We're about a block and a half or 2 blocks away from the congressional office buildings. And that's sort of symbolic. The CBO is a support agency, but we're independent. We support both the House and the Senate and both the majority and the minority. We support everyone. We do it in a nonpartisan way. And the CBO doesn't provide policy recommendations. So we provide information on the budgetary cost, the economic impact, other things, but we don't tell members of Congress, do this or do that, or this is the right policy or that's the wrong policy. We're just here to support them.
That's wonderful. And that's why I'm so excited to talk to you and have our listeners talk to you. As reiterated by Philip, the CBO is a nonpartisan body supporting Congress. And if you're an accountant like we are, the saying holds true, numbers are the numbers and they don't lie. So we're excited that we can really just have a direct conversation of how federal tax revenue can impact the overall federal budget. So we're going to dive right in here. And if you haven't gleaned already, the Congressional Budget Office helps obviously do the current year budgetary forecast, but also predicts 10-year forecasts. And it's important to understand how tax revenue is intertwined in that. So we're going to start with the most basic question, probably, Philip, is why is the federal tax revenue, and when we talk about that, we're talking about individual income tax payments, payroll taxes, corporate taxes, et cetera. Why is that so important to the process that you and your team do at the Congressional Budget Office?
Okay, no, very good. And it's one of the foundational activities we undertake to support the Congress, and that's to make budget projections. So we first say, well, what are the budget projections under current law? So that's the baseline. And that's the outlays, all the different types of federal spending, both the discretionary spending and the mandatory spending, net interest payments, which is a type of outlay, the servicing of our debt, and then also revenue. And CBO tracks all of this. We track what's happening in the current year, but we also do projections out, and generally 10 years for some things further out. Social Security, we project out to 75 years. And revenues that's the key piece of overall revenue is individual revenues. We have corporate revenues. There's tariffs, of course. That's revenue. There's payroll taxes, excise taxes, and we track all of it. And importantly, to make our projections of revenues, we have to have a sense of, what's the economy and what are the factors playing out on the economy. And so we project that. We project GDP growth. We project incomes. We do it separately for each of the major taxes. So we have individual incomes. We have corporate incomes. we look at the labor market since that drives payroll taxes and so on. And so all of that comes together to give us a picture of what's happening with revenues, and again, under current law.
Perfect. So what we're going to talk about first, I think, is we're going to focus on revenue. And what's interesting is the CBO essentially had to estimate revenue considering the TCJA acts expire, right, at the end of 2025. But then they also did an alternative a budgetary projection, indeed, if they were extended. And so we're first going to talk about, assume that the TCJA cuts have expired, and we're going to look at that first 10-year projection. So back to the original comment about tax revenue, in the 10-year projection, they actually have, let's talk about, I'm going to take one step back and talk about the 2023 actuals. So in the 2023 actual revenue, individual income taxes and payroll taxes made up 85% of the government's total revenue. So that was a significant number, right? And that's what we are often talking about, individual income tax rates, 190A pass-through deductions, all our flow-through entities like partnerships and S corporations would be captured in that number. And then it went on to reflect that C corporations make up about 9% of that total revenue. So this was 2023 actuals. Based on the 10-year projection, we're going to see individual income tax and payroll taxes to increase by 71% by 2034 when compared, back to the actual 2023 numbers, and corporate income tax will increase only by 21%. And that's not asking for a comment, Phil, just giving the numbers and the stats so that people are aware that, there is quite a large projection that's looking forward to a significant increase in those individual income tax rates and payroll tax rates. One of the things we'll talk about later, which I'm so impressed and happy that you released this report in July, is debunking the sometimes misunderstanding of how immigration impacts our federal budget as well. So if you go a little bit further, we're just going to talk about, not only the revenue, but with that revenue, right? In 2023, we ran a deficit, meaning obviously the revenue we picked up was less than the actual items spent. I want to take you mentioned some really good terminology that I think often, if you're not involved in reading and going after these types of and reviewing this type of information, you might be caught off guard when you hear these. But when we look at the expenditures, as Phil talked about earlier, we look at what we call mandatory spending, right? And then we go on to discretionary spending, and then we talk about interest expense. Those are like the three main categories of our outlays. And so in 2023, our mandatory spending was about 61% of our outlay. Our discretionary spending was about 28%, and our net interest expense is 11%. So first, do you want to give a little bit of background of what those groupings are and what they mean, and then focusing on where those potentially are going to go as a percentage of the overall budget when we look at our 10-year projection.
Okay. No, very good. Yeah, and that's great for me. I mean, this is in some sense CBO 101. Like, what is the baseline? How do we do projections? And that it's really our bread and butter. So I'm glad we're starting here. And it's I would say to listeners, if you go to the CBO website, so cbo.gov, we have a one-pager, we call it By the Numbers, that give the latest figures both for the budget and for the economy. And for the budget, we do it both in dollars and as a percentage of GDP, so as a share of the economy. And that really gives you the kind of perspective that Lynn was talking out about, sort of what are the different shares of spending and revenues and where are they going over the 10-year budget window. So that'd be great. So take a look at that at cbo.gov by the numbers. And so the different types of outlays, let me start there. In substance, there's three main categories. We both mentioned net interest outlays, and that's the payments on the debt, the servicing of the debt, the carrying cost. Sometimes people call it. And of course, that reflects interest rates and the stock of debt. So the past deficits that accumulate into the debt. And then there's discretionary outlays, and that's the spending that Congress decides every year. And it's large parts of the government. Well, defense is discretionary, is largely discretionary. On the non-defense side, it's the national parks. It's a lot of federal assistance for education, for nutrition, sort of a whole sort of swath of things, justice, all the things the federal government does that's not automatic. And that last part, the automatic part, is what we call mandatory outlays. And that's Social Security, Medicare, there's some subsidies for insurance, various types of insurance, the federal part of Medicaid, for example. There's some other things, lots of other things. And that's mandatory in the sense that Congress doesn't need to vote on that year by year. It's an automatic outlay. If someone's eligible for it, they're entitled to it. It's an entitlement, and there's mandatory spending. So that's on the outlay side, the three pieces. And
so Phil,
please go ahead.
Yeah, I want to, and I think it's important for our listeners to realize, and you can obviously correct me if I'm wrong, but oftentimes of late, we've been passing tax reform through a budget reconciliation process. Mm-hmm. And the budget reconciliation process does not allow you, right, to change that mandatory spending. So oftentimes the budget reconciliation process where we're seeing these tax breaks, they couldn't in the same vein, right, attach some type of adjustment to mandatory spending. Is that correct?
It's different. So reconciliation is a great topic. There's sort of lots of details. It's not a rabbit hole because it's really it's a fascinating topic. There's some things that are off limits under the Senate rules in reconciliation. Social Security is one of them, and Social Security is the largest mandatory program. Yeah. There's other parts of the mandatory side of the budget that are in bounds, so to speak. Okay. So it's the big pieces out of bounds, but some parts are in, and tax rates are in, and so so it's a mix of those things, and it all so it all depends on the Senate budget rules, and sort of lots of sort of on the ground decisions made over in the Senate, what's in and what's out.
But so that's great clarification. Let's look at that though, and the fact that when we're trying to adjust the budget, right, to have less of a deficit, to the extent that we can't touch Medicare and Medicaid, right, because we're not able to get, law through, that essentially means that expenditure is going to stay steady. And as you're probably going to talk about, is significantly going to increase over the next 10 years.
Yeah. No, that's right.
Right. And the only thing we can change with budget reconciliation, not the only thing, but the primary utilization of it would be for the revenue piece. So it is interesting how, and we'll talk about this in our next podcast, how the elections could or could not, depending on if there's a sweep by one party or the other, could or could not impact what Congress can actually do in this genre area of whether they can, go after or evaluate the largest mandatory spending item of Medicare and Medicaid, or if they would essentially be limited to budget reconciliation. So I just like to point that out. Okay. So I appreciate that.
Yeah. And with the, you mentioned before, there's a large part of the 2017 Tax Act that are expiring at the end of 2025. Those were enacted using reconciliation, and that's part of why some of the provisions are expiring. And so it would be natural if reconciliation happens next year, which depends on the outcome of the election. As you'll discuss in a future podcast, it'd be natural for tax policy to feature prominently in those future discussions.
Absolutely. Thank you. So we talked about the three items. We've touched on it a little bit, but between mandatory spending, discretionary spending, and interest expense, I would say out of all three of those, I would ask you, the discretionary spending, partially because of what was agreed upon on the last debt ceiling, has stayed flat, right? Or was increased maybe 1% in 2025. There hasn't been a significant variance in that. And that discretionary spending number. But then I would ask you, tell me more about the forecast of, the mandatory spending and the interest expense, the net interest expense, and what that's going to look like over the next 10 years.
Yeah. Okay. No, that's exactly right, and that's drilling down into the numbers is exactly the right place to go here. So I'll read out some numbers from our projections for 2024. That's the fiscal year that goes through the end of September. So we have the total deficit at nearly $2 trillion. It's 1.99 trillion. So call that 2 trillion. All of discretionary spending comes to $1.8 trillion. So whereas mandatory spending comes to $4.2 trillion. So in other words, you could policymakers could zero out all discretionary spending, and it actually wouldn't zero out the overall deficit just because of that. And I think that illustrates what you were saying: the composition of our outlays between discretionary spending and mandatory. And of course, discretionary spending is super important. It's it's important to every American. It's important to members of Congress. The deficit is so large now that addressing it really requires looking beyond discretionary spending. We have to eventually, it doesn't have to be today, tomorrow, but eventually policymakers will need to look at either outlays on the mandatory side or revenues.
Because exactly, Philip, you hit it right there, or revenues, right? And so that's where people are saying, could Americans obviously absorb some type of tax rate increase? Potentially, but we also know that has an impact on the economy and the growth of the economy, which also interplays into the budgetary aspect.
Right.
But at some point, there's just going to be no more blood from the rock, for lack of terminology.
Yeah. And of course, that's for policymakers. That's the thing. That this is a CBO. We do the analysis along with is a sister agency that's actually in the same building. I'm pointing to my ceiling because the Joint Committee on Taxation is one floor above CBO in the Ford House office building. And by statute, JCT evaluates tax policy. We work very closely with them. But that's the challenge for policymakers, is to say, well, when should fiscal adjustment or deficit reduction take place, and what should be the composition, whether on the revenue side, on the outlay side, what's the timing, what's the composition, and lots of things like that.
So exactly. And so one of the items that we were talking about that I find so, fascinating and interested to hear your thoughts on it is our net interest expense. Mm-hmm. So there's a lot of talk out in the world right now. If you haven't heard it, I will bring you up to speed that there's often a common measurement, right, between debt that the U.S. holds and GDP. And so they talk a lot about the debt to GDP ratio. And we had a very high debt to GDP ratio during significant events such as World War II, right? But now the trending seems to be that we will surpass that spike come in the future years. Why? Because some people just say to this issue, why don't we just borrow more debt? Why don't we take on more debt? Can you explain, why that analysis point has become relevant, and what really net interest expense already is, even without additional debt being taken on?
No, very good. Okay, so I'll start with some figures and then zoom back out and explain what they mean. So we project net interest outlays this year, 2024, to come to $892 billion. And again, compared to defense, we have defense discretionary spending at $849 billion. Mm-hmm. So there's lots of money in both interest and defense. This year, we project more money being paid for interest outlays than for defense spending, which is, I think is, a significant milestone. And of course, interest payments have to be made, right? That reflects the debts we've incurred in the past. The challenge for the U.S. is that interest rates today are higher than they were, say a decade ago. They're lower than they were in the 70s for sure, but higher than they were a decade ago. And we also have more debt. So both the base and the rate is higher. And so net interest payments have risen and are set to rise further.
Yes. And I'm just going to echo, I don't think Philip is the only one who's concerned if the interest goes above, the payments on defense. Wall Street Journal just had an interesting article on this, and really pointed out that to the extent you're spending more on debt interest as opposed to your defense, that it could really threaten the stability of the economy. So I do think, that's definitely something that should be watched out for. Before we leave this space of overall budget projections, we obviously have been talking so far about the numbers we've been utilizing is if the TCJA sunsets. I think there is, obviously some anticipation that something will happen, but not all of it. But let's take worst case scenario and say all of the TCJA doesn't sunset. What does that do to our deficit?
Yeah, so that's interesting. So under current law, as you said, large parts of the 2017 Act are set to expire and revert to the pre-2017 Act tax provisions, and it's all the personal side, the tax rates, the state and local deduction, estate tax, child tax credit. Some parts of the business side are also set to expire, but the international provisions are largely not, and the corporate rate is permanently lower. So it's a mix, and our budget baseline reflects current law. So in our budget baseline, if you look at our figures, we have revenue going up in 2026 from 2025 to 2026, and that reflects the expiration of the 2017 Act, means higher rates. And of course, there's an economic impact, as you said. The higher rates will have an effect on the economy, impose some drag. But even with that drag, revenues will still go up as the tax cut is reversed.
And so if the tax cut isn't reversed, how much will the deficit increase in 2020?
Oh, yeah. No, exactly right. And you had mentioned this report earlier in the podcast. There's a report on the CBO website that looks at extending temporary provisions. It's budget outcomes under alternative assumptions about spending and revenues. So that's the formal title of the report. And one of the numbers in there is calculated by our colleagues at the Joint Committee on Taxation, and it says the cost of extending all of the expiring provisions comes to $4.6 trillion over 10 years, including the interest payments that would have to be made. And I'll add one more thing, which is that's if the provisions were extended now, but it doesn't seem likely. It doesn't seem like it's going to happen in the balance of this year. If it happens in 2025, well, that means there's an additional year of cost at the end, right? And then it includes 2035, and so the cost would be higher. And so JCT has to do the work, but one can imagine, it's going to be north of $4.6 trillion. And that's for all of the 2017 Act. If policymakers extended parts of it, so say the parts that are for families below $400,000, which is a common demarcation that members talk about, well, that actually is more than half of the dollars. So it's north of $2 trillion just for the pieces below $400,000.
And this is always just my comment when someone brings up the 400,000 and the 450. I always like to point out to everyone that was what was used 4 years ago, and there's obviously been quite a bit of inflation. So that hopefully number will get adjusted if they're still trying to mark to that. But I know that obviously that's a congressional decision.
Yeah, and actually, can I just add, it's a great point you just mentioned that all the numbers are using are nominal dollars. And a nominal dollar in year 10, even with 3% inflation, is different than a dollar in year one.
Right.
The Congressional Convention is nominal dollars during the 10-year window, and so that's what I'm talking about. And that's why our by the numbers, the one pager also shows percent of GDP, just because then that adjusts for the nominal size of the economy.
Wonderful, great point. I think too the other thing that I like to stress to the listeners is, obviously there is going to be some type of increased revenue. We don't know what that might look like. But I think part of our conversations when we talk to our congressional leaders and our policymakers is to say it doesn't necessarily just have to be focused on the TCJA sunsetting provisions. I feel as though that's, what they're anticipating. But, obviously, Philip mentioned as well, the corporate tax rate was 21% is permanent. I get a vibe from the C Corporation arena that they could anticipate, 2 or 3 or even 4 percentage points up on that. And there's other interesting factors at play here, right? This is where we're really encouraging people to think outside the box. One of them, is 1202 qualified small business stock exclusion still really needed when you have a 21% corporate tax rate? The other item that came up of interesting note was, one of the main reasons, whether you agree with marijuana being legal in states or not, one of the main reasons states made it legal was the ability to tax it. And so should there be some excise tax at the federal level that would help spur revenue? So I think that's one of the things that is our task over the next few months, is to think outside the box and try to the best of our ability to limit the impact on Main Street, obviously, and family and small businesses. So
I was thinking the metaphor that jumped into my mind is the Kevin Costner movie about the Untouchables.
Oh,
right?
yeah.
About going after Al Capone and,
Yes.
so yeah, but what's in and what's out, what's taxed, what's not taxed at the federal level. And of course, CBO doesn't make policy recommendations. So we support the Congress, but the decisions about, what the right thing to do is and what should be on the table and not is entirely up to policymakers.
Absolutely. And I would say the greatest example of the untouchables, at least based on the past 10 years, is the carried interest deduction. So it's just interesting to me, if we can expand the conversation. And again, that you need a lot of other rocks to fall in place for that to occur, but hopefully we'll be able to get there. I just want to shift gears a little bit because on policy, I think so many times I have an article that will come out in the next week or so that stresses, like, although I'm an accountant and I'm a tax person, and I'd really like for everybody to focus on federal tax reform as soon as the November elections are over, there's two, what appear to me, pretty big hurdles that they have to address. The first one surrounding the debt ceiling, and the second one surrounding immigration policy. And I would say, believe it or not, to our listeners, I personally feel that all three of those items are integrated, right? Tax reform, debt ceiling, and the immigration policy, because and we'll talk to Philip about it more, because how the debt ceiling goes through, if it goes through, as well as immigration impacts, right, his revenue, and not his, but the Congressional Budget Office's revenue and expenditures. So I'm just going to, for a bit of background for our listeners, if you haven't familiarized yourself with the debt ceiling limit, the debt ceiling limit is out there essentially to allow debt, a certain amount of debt to be serviced, right, without having to go and get congressional approval every time. It's significant for us because if the debt ceiling isn't essentially raised, then the Treasury Department can use extraordinary measures, which people estimate every time different, a couple months, 3 months, to get us through that patch. But at some point, we'll go to what they refer to as an X date. And at that point in time, we won't have the ability to source our debt, right? And so we'll default on our debt, which is obviously would be catastrophic for our economy. So this has been more and more becoming a heated debate within the congressional leaders, to saying, I don't want to just keep upping the debt ceiling without being fiscally responsible. And I'm sure you'll all remember this. The most heated, most recent was when Senator at the time, House Representative Speaker McCarthy worked with President Biden and essentially compromised on this, found a compromise, and therefore lost his speaker seat. One of the primary reasons he lost his seat. So it is a big issue. Based on that 2023 agreement, the debt ceiling discussion, reinstatement comes in again on January 2nd of 2025. So thankfully after elections, but not soon, very soon after the elections, right? Not a couple years from now. So I guess I would ask to you, Philip, how, if the agreement regarding the debt ceiling can't occur, what do you think that means for the U.S. federal budget?
Yeah, it's it's an important issue, and as you said, the Treasury Department has some tools, the so-called extraordinary measures, to extend, the X date, as you call it, at which we sort of run into trouble with servicing the debt, and it's hard to contemplate what would happen if the U.S. doesn't pay its obligations. I mean, it's happened in sort of technical terms a couple of times over the last several decades, but just sort of minor sort of foot faulty things. We've never had a sort of a real problem. And so members of Congress have always addressed it, and the CBO projections are predicated on the debt ceiling being addressed. It's important to members. I mean, members, lots of different members look at that and say, we want to be fiscally responsible. And even if we don't solve our fiscal problem on, this date or that date, to make progress and have momentum. And so that's, is part of the conversation around it.
Yeah. And I would just highlight, there was, Speaker McCarthy didn't just increase the debt ceiling. There was some agreement on discretionary spending, right?
Mm-hmm. That's right. And that's the Fiscal Responsibility Act. And right. We, in our February budget update, we provided some information about the impact of that in bending, reducing the trajectory of deficits. It was a meaningful amount. It didn't, sort of solve the problem entirely, but it showed up as a meaningful amount. And that's the kind of the kind of action that many members are looking for. Knowing that is a first step, but members are looking to make steps, and that's
absolutely. Yeah. And I think showing you at that time too that they needed some type of control or agreement over something in the budget to get that to get the budget cap the debt cap increase. So I think it's definitely going to be a debate. I think the debate will start sooner than we think, meaning it probably will indeed take priority before federal tax reform. But obviously, that will have an impact on what do we need our tax revenue numbers to be in order to have less deficit. The last topic I want to talk about with you before we open it up in general for parting comments is it seems I was very pleased to read in July of 2024, the CBO published the estimated effects of the immigration surge on the deficit. And if you aren't aware, right, if you don't look at this type of information, I think it's common perception. And again, we're only talking at the federal level. I know the state level is not completed, but that immigrants are costing us money, right? Certainly, it's been said immigrants are taking our jobs. And I believe this report, I'd like you to speak to the fact of what did, this is based on fact. What did the immigration policy that was of today, how did it impact and how will it impact our budget, right? Our federal budget. And is it creating more deficit or less?
Oh, okay. Yeah, no, thanks very much. And, as you said, we focus on the federal budget, and there's important impacts of immigration on state and local governments that we just don't have as much visibility into. Education costs and justice costs and things like that. For the federal government, we've seen the budget and economic impacts of the surge of immigration that started in 2021. And we project that going through 2026. But obviously, it's something we're tracking, whether it continues or not. The immigrants who are coming across the border, and generally the southern border, but in other ways as well, they're disproportionately working age men. And many of them receive work authorization about 6 months after they arrive in the U.S. Through various channels. That we've discussed in our immigration reports. We put out actually a long immigration report on Tuesday, July 23rd, which goes through some of the details. But so the immigrants receive work authorization. Many of them will have an appointment with a immigration judge, years in the future, basically to sort of adjudicate their future status. So they have a pretty strong incentive to work on the books. So they're paying taxes, they're contributing to Social Security, to Medicare. Many of the federal benefits they're not eligible for several years. So Medicaid, for most of Medicaid, there's a 5-year delay. Social Security and Medicare, there's a 10-year delay. You have to have 40 quarters of work history. So it means that there's sort of a the labor force is higher, the economy is higher, revenues are higher, outlays come, and there's some outlays, but many of the larger outlay pieces are delayed or later in the budget window. And so it has so our 10-year figure was that the net budget impact was about $900 billion in deficit reduction from about $300 billion of outlays and $1.2 trillion of incremental revenue.
Right. And so I think, that's not, I think, the anticipated expectation, but it is important to realize that to the extent we are, as we saw in the forecast, that the individual income taxes and payroll taxes are increasing, a portion of that is due to immigrants coming, right, and their strive to work, right, as you said, after they get their papers in 6 months. But also, right, so you say, okay, I understand that, but the complexity as well to say, but when they do that, they also are paying in towards Social Security and Medicare, even though they can't draw down on the benefits for a 5 or 10-year period. They're helping that cost that keeps increasing to indeed to become less. So I thought that was really interesting, and it was a great read, and I would encourage others to read on that as well. One of the last things I just want to talk about before we open it up is the CBO had to make an adjustment to their budgetary figures this year, right? Their 10-year projection. Mm-hmm. And I think sometimes without digging in, people felt that there could have been an error or have a lack, maybe are questioning the trust of the numbers, right, that the CBO is utilizing. But I wanted to provide you some space to explain how that was really more related to executive orders than anything that was in your.
No, thank you. Yeah, it's one of our functions is to update our budget projections so that Congress has updated information, and then also we do our cost estimates, our analysis of proposed legislation against the most recent baseline, and we adjusted the latest adjustment was in June. And that was an adjustment from the previous one, which was in February. And from February to June, there are some major changes in the budget outlook. One was on student loans. So the administration did more student loan forgiveness and then had a proposal for yet more. And CBO had no opinion on whether it's a good idea or bad idea, whether it's legal or not legal. That's up to policymakers in the courts. We just calculate the budgetary impact. And that was more than $100 billion, built with a B, just from February to June, what they announced. There's some higher spending than we expected in Medicaid and in the subsidies for the health insurance policies purchased through the Affordable Care Act. And some of that related to what's going on in the economy, some of that related to immigration, some of that related to executive actions taken by the administration. And there are other changes. The appropriations were more than the continuing resolution and sort of other, budgetary jargon. But that's, for us, we track what's going on in the economy and the budget. And when the administration takes an action that increases the deficit, we track that, we provide information on that, and that a big piece of February to June was just that.
Yes. So there's a lot of headlines about the adjustment, but I would urge people to keep reading to understand.
Yeah. Look, that is important for us to make it clear that we want to set out as clearly as we can. Well, what are we projecting? Why? And then what changed? And it's something we're constantly working on, is to increase our transparency.
Yeah, beautiful, wonderful. So as we wrap up, one of the comments I think I recently heard, and you can correct me if I'm wrong because I don't have it in front of me, is that you said the federal budget outlook is daunting. Mm-hmm. Is that, yes?
That is my term of art, daunting, and it's you choose your metaphor, but if for people who are downhill skiers, you're at the top of a run that looks really steep and it's daunting. So you're looking out on it and it's daunting.
Yeah. So I think, overall, I would just say, again, the purpose of us having our discussion today is that indeed it is daunting, right? We're seeing increased deficits. We're seeing increased borrowing. We talked about the interest overseeding the defense. And so many of these things that we're talking about, right, debt to the extent of GDP percentage, haven't been seen before in the United States history. And no one has a crystal ball to say what that is going to mean 5 years from now. But part of the responsibility, obviously, of the CBO office is to do their best at projecting what that indeed could be. And I think that this topic is so extremely relevant because if you're going to your congressional leaders and you're talking to them about tax reform, most likely, right, for them to be able to discuss it or adjust it or promote it, they have to understand exactly what the CBO does and score it, right, to make sure that they indeed understand, the impact on the federal budget, which is why we're here today, right? This is as far top as you can go in a tax reform discussion. Is ultimately the revenue has to come from somewhere, and where would that be? Again, we hope that we can really look at the untouchables, as you said earlier, or maybe just thinking outside the box when looking at the different type of revenue streams that we could create or modify. But on that note, Philip, I have any closing words or thoughts you would want, the general majority business owners, individuals to know that would be important for them to know about the CBO and the projection process?
Yeah, no, thanks, Lynn. It's this has been great talking, and I would just encourage the audience, look at our website, look at by the numbers. Look, if there's a particular part of the federal budget on the revenue side or the spending side that you're interested in, there's going to be something about it on the CBO website. So take a look, and just keep in mind, we do analysis. We don't tell policymakers what to do. So if something is there or not there, it doesn't mean we think is a good idea or bad idea. And that, as you said, that's up to policymakers, is for them to decide how to address the daunting fiscal trajectory. And we are here to support them as they face that.
Wonderful. And as we said earlier, the numbers are the numbers and the numbers don't lie. So that's why it's really important to get comfortable with those reports. And I would just add that we will put the 10-year projection without the extension of the TCJA cuts as an attachment to review, the immigration CBO report to review, along with projected changes if the TCJA indeed didn't expire. So we're going to provide that as reference material, maybe help you have less clicks and while you're listening to this podcast.
No, all good. I mean, our materials are in the public domain, so we're here to help people, and the more you send out, that's great.
Perfect. Okay. Well, I want to thank you for your time today. Again, we were honored to have you discuss this really important topic with us, and wish you the best of luck in what I'm sure is going to be not only a daunting budget outlook, but a daunting, 8 to 9 months. So good luck.
No, thank you, Lynn. It's really a pleasure.
Okay. Take care.
No, thank you.
You've been listening to Withum's Tax and Topics. Contact us with your feedback or suggestions for future podcast topics. Visit www.withum.com for additional information. Send an email to info@withum.com or follow us on Facebook, Instagram, or Twitter @WithumCPA. Thank you for listening.